So the question that we're all asking is, should I invest in dividend stocks during a stock market crash? And the answer is definitely yes, and that's what this video is all about. I'll cover exactly why you want to invest in dividend stocks during a dip in the market so that you can execute whenever they go on sale, and that's going to make you a lot more money in the long term. Now, I am not a financial advisor, and this is just my opinion, so take this for entertainment purposes only, but now let's start talking about investing in dividends during a market crash. So if you're watching this video right now in March of 2020, then you are well aware of all of the ups and the downs that we've been seeing in the stock market because things have been crazy lately. And that's just how it's going to be, I think, for a little while, but hopefully it'll stabilize and then eventually we'll get back to normal. But if you go back all the way to the beginning of the stock market, you'll see through history that there's always been ups and downs, and then it's very normal for the stock market to stabilize itself. And that's just the way that it's always been, and that's how it's always going to be. Obviously, it doesn't feel good to lose money, and it seems like every single time I've been opening up my retirement account lately, it just keeps getting worse. But I know that everything's going to be okay because I'm in it for the long term, and I'm not planning on touching that money for a very long time. Now, even if the market is going down, it's actually a good thing if you've got some cash lying around, because if you've got some extra money to invest in, then now is the time that you can actually get into some of those companies that you've always wanted to invest in, because now they're on sale technically because the market is lower than it used to be. And then on top of getting really good discounts on all the companies that you want to invest in, their dividends are also going to go up because their stock prices are going lower. And I'm going to explain how that's working right now. So the way that dividends typically work is that they're paid out on a per share basis. So basically, if a company was paying out 15 cents a share and you owned 100 shares of that company, then you would get $15 as a dividend because you had 100 shares at 15 cents each. And most of the time, dividend payouts generally stay the same whether the market goes up or the market goes down. So basically, if there was a company that you were looking at that was $100 a share and then it went all the way down to $50 a share, then the dividends would stay the same. So you could actually invest in twice as many shares for the same amount of money, and your dividend would actually double as well. Because let's pretend that you only have $500 to invest with, and you want to invest in a company that costs $100 a share and they have a 5% dividend yield. Well, because you only have $500 to invest with, that means you can only buy 5 shares of that company based on their current market value. But if the company's value all of a sudden dropped to $50 a share, then your $500 would actually get you 10 shares, and that would essentially mean that you double your dividend to 10% as the yield. And that's because remember that dividends are paid on a per share basis. So now if you own 10 shares versus 5, then you're obviously going to get double the dividend because you have twice as many shares. Now that's just simple math and there is more to it, but hopefully now you guys can see why buying a dividend paying stock when the company's a lot lower or when the market's lower is a better value for you, because you're going to get more return on your investment because the stock price is lower when you're buying in. So if there are some companies that you've always wanted to invest with in the stock market, then obviously waiting until there's a dip or a market correction is a really good time to get in, because then you're always buying low and then potentially selling high, and that's exactly what you want to be doing. And remember that you always want to take on a long-term approach to investing. So if you're looking out even 5 to 10 years into the future, then that's really good, because if there happens to be a market correction tomorrow, then you're going to have enough time to fix it. But in reality, if you needed that money in a week and there was a problem, then you're probably going to lose money, and that's not how you want to invest. You want to make money when you invest and not lose money. Now, if you just found this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So if you do find an interest in that type of content, feel free to subscribe. But for now, I'm just going to leave another video up here on the 3 best stock trading apps that you can use for investing. So you can check that out if you have an interest. But thank you for watching this video, and have a good day.